Okay, so let's go ahead and get officially started. I'd like to officially welcome you to today's webinar. This webinar is titled Three Strategies to Protect and Grow Your Retirement Nest Egg. And my promise here to you today is that my goal is to lay the foundation so that you know that you can retire with a peace of mind knowing that you can steadily grow your portfolio, generate a safe, steady income, and most importantly, as you'll hear me say throughout the presentation, that you'll know how to preserve that you'll know how to preserve your capital. Okay, that may be the most important factor of what we talk about today. Okay, so that's my promise to you. If you would, if learning how to do this sounds good to you, if you would now, it's a great time to turn off all the distractions. You can close any doors, turn off, well, at least put your cell phone on vibrate maybe, close any other windows on your computer. Uh, I think you get some good information in the next hour. So I'm looking forward to it. And let's go ahead and jump right in. Let me introduce myself. First, my name is Jim Penna. I'm the manager of retirement services here at VectorVest. I've been with VectorVest for 14 years now, helping our subscribers and students learn how to build, manage their portfolio. Also, we'll talk a little bit about covered calls and options today. I also help out with some of the options instructions here as well. Now, before I came to VectorVest from Connecticut about 16 years ago, I moved to North Carolina, found VectorVest, and it's been a great ride ever since. I was a market maker for on some small trading desks, and then for a larger market making firm before I moved my family down because I got tired of shoveling snow. So we came down, and that's how I ended up here at VectorVest, and that's a little bit of my background. Just kind of lightheartedly, I like to tell you if at any point during the webcast it sounds as though I'm telling you what to do. Back in Norwalk, Connecticut, I was also a police officer three lifetimes ago for just about 10 years, just under 10 years. So if I start telling you what to do, that's where that comes from. Anyway, let's go ahead and get started. A lot of what we do in the retirement services department, we talk about things like the ultimate retirement solution, and a lot of it came from a quote, or at least, well, it didn't come from a quote, but here's one of the great quotes that I found that encapsulates what we try to do here. And it's from a fellow Connecticut Yankee called Mark Twain. You may have heard of him. And he said, don't just sit there and worry. Be proactive. Do something, anything about what's worrying you. So you can gain information, focus, and control over the situation. And when I found that quote, the more I thought about it, it's exactly what we need to do, right? We need to be proactive. We need to know what to do and how to prepare for retirement. And so I always love starting off with that quote. The idea, again, is kind of built around that. Is I had a conversation with our founder and mentor, Dr. Bartolito. He was the founder of VectorVest, and a long time ago, we were talking about folks that I get to speak to, whether it's at webcasts or when we used to go on the road for our seminars. And talking with Dr. D, I said, the question that I get, or the issue that I always hear about, in some form or fashion, breaks down to this question: how do I keep from running out of money in retirement? And so Dr. D said to me, in only the way that Dr. D can, he said, well, James, just tell him to keep making more money. Teach him how. And so that's kind of the genesis of what we do here. And so here's what we believe at VectorVest. We believe that a secure retirement is one in which you have enough income to live the life you desire. Okay, whatever that might be. I use the cliche photo here. You buy a yacht, you float around the world. That's great. This couple did it. They were VectorVest. See, they even named their boat after VectorVest, if you notice that. Okay, it may not be the cliche of owning the wine vineyard or sailing around the world. It's whatever you desire. It might be sitting on the front porch with a good book and an adult beverage by you, whatever it is you look to do. We believe a secure retirement is one where work is optional and retirement is affordable. See, here's the retirement that I desire. Okay. And so before we get in there and talk about it, there's this system or this process that we talk about. How do we get to that peace of mind? We call them the three P's. First one is profit. Next is provide, and then preserve. Let's start with the profit side here. What we're talking about here is profit is simply building and managing a growth portfolio. In other words, buying good quality stocks, rising in price at the right time to grow and appreciate our capital. Right? Now, I understand that no stock or no portfolio goes straight up. We know that. But what we want to avoid is that roller coaster with those steep, dangerous moves to the downside, those violent drawdowns. We want to take that out of play, and we want to have the ability to have that roller coaster turn into a steady climb. So that's our profit side. Next, we talk about provide. What we mean here is providing a safe, steady income. Whether you're just approaching retirement or already in retirement. And so we're not talking about that, a couple of random dividend stocks that might pay a small dividend and you have that trickle down theory or that trickle into your account. That's not what we're looking to do. We would rather have a safe, steady flow that you can count on of income coming into your portfolio. Okay. And then finally, there is preserve. And I said before, it is still, in my opinion, the most important thing that you can focus on if you're managing your nest egg, your net worth. The first thing that you should have in mind is preserving that capital. Okay? And to do that, we want you to go from being unprepared, not knowing what to do when the market turns against you, right? And simply be prepared. As Mark Twain said in his quote, he said, he went on to read, I didn't read that part, but he said, I've suffered a great many catastrophes in my life. Most of them never happened. Right? In other words, he worried for nothing because he may have been unprepared, but we want you to be prepared. Okay, know what to do, know how to be strategically defensive in your portfolio. So when we put these three core strategies that I'm going to talk about together, we can reach the goal that I laid out just a few minutes ago. There are going to be some points throughout the presentation where I want you to kind of interact with us. So I'm going to ask you to start here. What's the hardest part about whether you're preparing for retirement or if you're already retired? If you could type in the chat box just a couple of things that that you're working on or that worry you, that you need to be proactive about. So I'll ask you to go ahead and just in a few words, type in what's worrying you or what you need to work on for your retirement. Graham says nursing home fees. Yeah, right. That falls under keep making more money. And John, consistency kind of comes along that as well. Charles says outliving my money, and that was always a conversation we have with Dr. D. That always used to come up. How do I know how long I'm going to live? Right? So how do I plan for that? And Dr. D, and this is kind of where that whole, how do I keep from running out of money? Just keep making money because we don't know, right? We don't know. And that's a great question. We hear it all the time, or a great comment on what to worry about. Okay. Leo says many ways to plan consistent income, Gary says. Yeah, so a lot of these are, we hear a lot here in retirement services. And based on what I'm seeing, it sounds to me like you guys, I think, are in the right spot today because we're going to address directly or maybe one or two of them indirectly, exactly what you guys are talking about. So let's jump into it. So the three core strategies, as I mentioned, capital appreciation, that's the profit. Income is the provide. And then finally, capital preservation. Let's start with capital appreciation. So when we talk about the profit side, we know that capital appreciation comes from owning companies with consistent and predictable financial performance. I always ask what two better adjectives are there to describe the stocks that reside in your portfolio than consistent and predictable. Okay, so that's what we look for. I'll use more than a couple baseball analogies throughout the presentation. A long time ago, I played some ball in college, and I love baseball, and I love the New York Mets. And, I use this quote from Dr. DeLito, good portfolio management, it starts with buying the right stocks. And so I always liken that into pretending you are the GM or the coach of a team, whether it's based, whatever sport it might be. Okay. I've used different teams over the years, and if there's anyone from the Chicago or Oakland area, I apologize for putting the 69 Mets in your face, but when you build a team, when you've got stocks in your portfolio, it's like having the best players, like having Tom Seaver on the pitcher's mound, right? So we want to make sure we fill our portfolio from the very best roster that we can. That's how you win games, and that's how you grow your portfolio. Okay. Yeah, Charles says, yeah, Yogi is up front. And I could name all those Mets, but I'm not going to bore you guys with that. Just know the analogy is that build a good team, build a good roster, and you can grow your portfolio. And we believe that it begins with safety first. In other words, especially for our retirement account and our growth portfolio specifically, you want to look at a company's safety, really more so than anything else. Because to continue the baseball analogy, while it's always fun to hit the home run, we also know what most home run hitters do when they don't hit a home run, especially in this day and age in the game of baseball. Right? It's always been true to a degree, but more so now. But if the home run hitter doesn't hit a home run, he's going to strike out. And that's not what we want to do as we build and manage our retirement portfolio. Striking out is not an acceptable outcome. Okay, so it's about safety first. So when we look at stocks, I'll show you some graphs in a minute, and we'll notice something that graphs have in common, that have that lower left to upper right pattern, whether it's earnings or the price movement of the stock itself over a period of time. Okay, we know that they satisfy the stock safety checklist. That's what they have in common. There are, six key factors here that Dr. Dolito used when he created an indicator within the VectorVest program that I'm going to talk more about in a minute, and it's called relative safety. But I think it's important to explain to you exactly the factors that go into that. So when I mention a stock that has a relative safety indicator of 1.48, you'll have a better idea of what that means. So I'm just going to take just real quick each checklist. Earnings consistency. Naturally, a company that makes money quarter over quarter, year over year is going to be a safer company to invest in. Company size is important. Okay, just because a company's small doesn't mean it's not a good company or can't grow. And just because a company is large does not mean it's a safe company. Okay, that's really the key takeaway. But otherwise, a larger company, and it kind of coincides with business longevity. Right? Companies that have been around, Dr. D writes, it's better to the devil you know than the devil you don't know. So company size and business longevity are important, and they play a factor in how we analyze the safety of a stock. Dr. D also used price behavior, right? Is how far above, a mean or an average of the stock has the stock price moved? How far below that mean might it be? Okay, these were important factors, and Dr. D put it in mathematical formulas to take that into account. Next is dividend history, right? A safe company doesn't have to pay a dividend to be considered safe. But if that company does pay a dividend, it darn well better continue to pay it, not only just pay it, but grow that dividend. Because there's no worse black eye for a company than to suspend or cut or, stop paying a dividend. It reflects very poorly on management, it reflects poorly on the company. So that's a big factor as well. If they pay, they don't have to pay a dividend. Finally, debt to equity ratio. Really all it is a company's balance sheet. Is it a favorable debt to equity ratio so that they can weather any kind of headwinds that come, whether it's the economy itself or something specific to the company, right? Is it a well-run company? Do they have too much debt? Do they pay too much interest so that they can't report a positive net earnings? Right? If you don't have a positive net earnings after interest payments and taxes, then you're never going to make it to what we call a high safety stock. Okay, now you could go look up a lot of that information on your own. But I promise you, through my experience, I know you're going to become frustrated. You're going to become inundated with so much data, you're going to get buried by it all. So what we've done here at VectorVest is created an indicator to assess the safety of an underlying company. And it's called relative safety, or RS, as you'll hear us refer to it. Again, it's the consistency and predictability of financial performance. Those are the primary factors in assessing relative safety. We put them on a scale of 0 to 2, like all of our proprietary indicators. Um, Anything 0.89 or less is poor, 90 to 109 is fair, and anything from 1.1 on up is anywhere from good to excellent. And this allows us to compare uh, apples to apples when we look at stocks. The way the information funnels into VectorVest and funnels out through Dr. DeLito's formulas allows us to assess the safety of an underlying stock. Let me show you an example. This is a screenshot from our Unisearch tool. Right, we have a very strong, for those who may not be VectorVest subscribers, we have what's called the Unisearch tool, search engine that allows us to find stocks meeting certain objectives or certain parameters. Well, here's one called ruler stocks, my absolute favorite search within the VectorVest program, especially for the more prudent / conservative investor. And what you'll see here is a spreadsheet. You may be familiar with it, you may not, but here's our proprietary numbers, and I really just want to focus on the column of relative safety. Okay, ruler stocks is a great search because just to make this list, by the click of a button, I can have a list of stocks who have a earnings growth rate in percent per year of 14% or better. I can also have a stock that has a relative safety number of 1.4 or greater, which is excellent, as I just showed you. Okay, don't worry about these other parameters right here. They're really not relevant to what I'm talking about. So these are the important key factors to the search, and then we sort the stocks. We take the list of stocks and bring to the top of the list the stocks with the best combination of relative safety times the earnings growth rate. So these two numbers are multiplied. And that's this number right here at the beginning of the spreadsheet. The beautiful thing about relative safety, and again, I'm not going to go into every indicator here and do a whole lesson on that, but relative value is defined as the price appreciation potential. In other words, the growth of the company, or the price of the stock, I should say, to be more specific. We have numbers like CI or comfort index, right? A company with and I'll show you in a minute, I'll show you West Pharmaceuticals. It's got a 1.71 on a scale of 2 comfort index. That's the price growth persistence, the ability to withstand lengthy or severe downturns. That's how we define that. Okay. The great thing about relative safety is when you have a relative safety number at these levels, all of the numbers I care about will fall into place. This was taken just yesterday, the screenshot. Relative, and listen, there are sometimes some exceptions. I think there's one in here with a lower relative value. Actually, they're all pretty strong. Well, one below one, just one. The other numbers are comfort index, all very strong, and the earnings growth rate. I mean, the worst earnings growth rate is at 19% per year in the top 20. Okay, so that's the power of relative safety as we search through and find the best stocks to put into our retirement portfolio. Okay, so that's a big number. Now, I talked about West Pharmaceuticals. It's actually last when you sort it by RS times growth rate, but it is the highest RS stock, and not quite the highest CI, but a very good one. So here's what a graph looks like. Again, this graph I took a screenshot yesterday, also yesterday morning. West Pharmaceuticals, great company. I actually own the company myself, and this is a 5-year graph with earnings per share down below. It's a combination of historical and forecasted earnings, and you can see that northeasterly direction, as well as the same for the underlying stock. Okay, that's not coincidental. That a company with strong earnings also has a strong movement to the upside on the stock price. Okay, as I said earlier, nothing goes straight up, and for a lot of these graphs and charts I'll show you, I can tell you what time of year it was, what year and what month it was, just by looking at them. Right? I know January and October of 2018 were very bad. Of course, we know February of this year was bad. But this is a 5-year look. As of yesterday, it had a relative safety indicator of 1.48. Now, I mentioned that a company does not have to pay a dividend to be safe, but West Pharmaceuticals happens to pay a dividend. And again, on the same 5-year graph, I can show you the growth of that dividend. In fact, West Pharmaceuticals is one of the rare companies that has not just paid but has grown their dividend every year, year over year, for 25 years or more. Okay. And we'll talk more about that, what I like to call the golden staircase. I'll talk about that in a moment. Um, I show ruler stocks. I talk about my favorite search being ruler stocks. Often I get the question, why are they called ruler stocks? Well, one of the reasons is it's an old saying that whether it's earnings per share or the price pattern of the stock, you could place a ruler there and just draw that straight line moving upward on either earnings or the stock. Again, as I said, I know nothing goes straight up, but you get the idea. So that's kind of where they get their name from. Okay. So when we talk about capital appreciation and we apply the power of relative safety, we assess that stock, and of course we buy it at the right time when the market is favorable, we're able to build a portfolio that looks like this. This is a model portfolio that is used in our we have, every Tuesday we have what's called the retirement coaching group. It's a separate entity, but we have portfolios that we build and manage. This one uses ruler stocks. Now there are other good searches and other ways to find IRS stocks, but this is my favorite. As of yesterday, this portfolio, which I'm going to say is, it's 3 years and what, 10.5 months, right? I'm going to call it 4 years, right? We're up 116%. This was as of yesterday's close. We're roughly right around there today. I believe it was up slightly today. Okay. Okay. I see somebody asking about the sound, and for some reason my screen is flashing every now and then. I don't know what that is. Hopefully it won't turn into a bigger issue, but I don't know if it has anything to do with that. But I see my screen flash a couple of times here. Um, we're at the mercy of live entertainment. Is at the mercy of technology. Anyway, so when you build a portfolio like we have here with a very prudent slash conservative risk management plan behind it, these are the type of results that we've gotten. Again, over about 4 years. What does that come to? Well, that's about a 28.2% return on investment, right? Annualized rate of return. Now, I don't know what you guys think, and if you don't think that that's really unbelievably great, then give me a call because we need to talk. Okay. With a very little time and effort put into this plan, 28%. Now, most folks will ask, usually hedge fund managers, mutual fund managers will ask, you know, how did you beat the market, right? Did you beat, and we use the bellwether, the S&P 500. I ran a quick test from January 3rd of 17 to yesterday at exactly 10:42 a.m. Eastern Time. The S&P 500 or the SPX was up 57.8% or 15% annualized. Well, up to that point, we doubled the return of the overall market. Okay. So those who will talk to you about passive investing and just simply be happy with your, whatever return you get over the years from the market, just know without a lot of effort, some effort, you got to put a little into it. But you don't have to live with just going along with the market moves. Okay. So I'm gonna ask you guys again to interact with me real quick. Which would you rather? I know the answer, but I want you to type it in because I want you to stay with me. Would you rather have a portfolio where you randomly choose stocks, you're not sure of the safety of those stocks, and go through that roller coaster ride? Or would you rather have a steady climb? So no safety or safety? Would you rather fill your and I say retirement, your investment portfolio, your longer term investment portfolio. Would you rather fill it with stocks that look like this? Or would you rather go for that ride that looks like this? And John said safety, of course. Again, I know the answer. I just want you guys to type it in there. Right. Gary says safety. Charles said, would you rather have 100 shares of a $20 stock or 10 shares of a $200 stock. Charles, the question, it leaves me not enough information to make that choice. I have no problem owning 10 shares of a $200 stock. Is it a good stock? Is it a safe stock? Did I buy it at the right time? Do I manage it properly? There's absolutely no difference in the percent return you're going to get. So the short answer is no, I don't care. Which one? I want the safe one. Gary says safe. Martin says no question, safety. And Leo said, yeah, Leo's saying safety, but in a different way. He said, I'd like to lower my blood pressure, and I'm with you there, Leo. I'm certainly with you there. Okay. And Monique says safety as well. Yeah, we know the answer. I just want you guys with me here. But that's how you do it. You find the right stocks, and we buy them at the right time, and we're able to grow our portfolio. Now, the next core strategy, I want to be clear. I'm going to shift gears a little bit here, because now we're going to talk about income. Right? It's one thing to allocate and have. Remember, I'll say this a few more times too. You always have to know the objective. When you hit the enter button for any trade, long term, a day trade, a swing trade, whatever it might be, okay, before you hit the enter button, you must know the objective of why you're hitting that enter button. What are you looking to accomplish? And I don't want to hear just make money. It's the worst answer I can possibly hear. I hit the enter button because I buy that stock because I want to make money. Okay, you have to have a clear goal and objective to hitting that button. So I say that now only because I'm shifting gears a little bit here. So when we talk about income, we are looking at a safe, steady cash flow, right? Goes back to one of the early slides, right? Just keep making more money. So we talk about the provide side, steady income. Now we get that income from two parts. This is a two-part under provide. There's two parts: dividends and covered calls. I'll talk about covered calls in a minute. If there's anyone in the room who doesn't trade options or are familiar with options, please do not be put off. Do not get nervous about the fact I'm going to talk about an option trade. Covered calls are the most basic, most popular income trade that there is. And it's the easiest, by the way. You don't have to be an options expert to understand the power of selling covered calls. Over the years, I've seen too many times, options, I can't do that, and walk away. And if you're here because you're managing your net worth, there's two option trades you need to know: covered calls and how to use a protective put as insurance in times of uncertainty. Let me say that again. If you're managing your net worth, you need to understand the power of covered calls and the importance of being able to insure your portfolio by simply buying a protective put option. Does not mean you have to read 15 books on how to be an option trader and understand all the Greeks in every trade that's in there. Okay, there's the two most basic trades there are. Okay, just want to get that out of the way before I continue. All right, so let's talk about part one: steady income flow from dividends. What's our goal here? Like I said, we're shifting gears. We're shifting our objective. I want to get paid. I want dividends to come in. I want a safe, steady income, and I want it from the type of quality stocks that I don't have to worry about. A lot of folks will simply go into Google, start Googling, good dividend stocks. You'll get a lot of results. But what happens, what they do on most of these sites is they simply sort by the current dividend yield. Right? The current dividend yield, the dividend divided by the price of the stock. I think that's the formula. Price of stock divided by the dividend paid. Whatever. Dividend paid divided by the stock price. Right? And they just give you the yield. That doesn't tell me anything. Here, the current yield is kind of down here, 32.85. That looks amazing. Current price of the stock's only $4. The price of the stock is $4, and they're paying a dividend of $1.36. Who knows how much money they make? I don't know if that's good. That's terrible, probably. Right? A lot of the websites you go to. Okay. But they never tell you anything about the company. So here's an example in VectorVest. Again, a search, and there's more than a couple. Like I said, there's more than just ruler stocks to find good dividend payers. I'm sorry, good capital appreciation stocks, but it's my favorite. And then here's a good one for dividend payers. Maybe 4 years ago, I did a special presentation, and I created this search, and I made it as basic and simple as possible. I want either Dow Industrial, Transports, or Utilities, because they're usually good dividend payers, or the stock has to be in the S&P 500. The stock has to pay at least a 3% dividend yield, and it also has to be on two watch lists within our program. What are those watch lists? One's called the DRIP 10 to 24 years, and the other is DRIP 25 plus. What does DRIP mean? It stands for Dividend Reinvestment Plan. So that all of these stocks that come to the list, you have the ability to automatically reinvest your dividends, to take advantage of the compounding of dividend payouts. And then finally, this is a VectorVest parameter indicator called dividend safety. It is the one indicator we have that is not on a 0 to 2 scale. It's on a 0 to 99 scale. And anything above 50 or greater, is what we're looking for. And the reason is because the 50 or greater ensures us that we have a favorable payout ratio on that dividend stock. And by favorable, I mean that the company is making more money than it is paying out in dividends. In other words, if the company's making, if their earnings per share is a dollar, and they're paying out $2 as a dividend, annual dividend, well, that's not acceptable, right? And so we make sure that payout ratio is better. Another way to do it is compare earnings yield to dividend yield. So if the dividend yield is 4%, that earnings yield better be greater than that. Otherwise, I can't count on the stock continuing to pay and grow my dividend. So this is the kind of stock. You'll see some very familiar names here. And before anyone types it in, you'll also see that the relative safety numbers are not what I was talking about in the first portion. And that's okay, right? Relative value numbers are strong. That's why growth rate and dividend growth rate are so important. And you'll see I use the sort, taking the earnings growth rate times the dividend growth rate and bringing that to the top of the list. Now, Hasbro's on there, a good company. We own that in our model portfolios. Alliant Energy is another good one long term. But what I want to talk about is T. Rowe Price. T. Rowe Price, like West Pharmaceuticals, another company I own in one of my more prudent conservative portfolios, is a wonderful stock, especially for dividend payouts. Now, here I have a 25-year graph. Here you can go out 25 years in the VectorVest program. I can go backwards. And what I have here is the dividend payout. Remember I talked about the golden staircase, and you can really see it here. T. Rowe Price is what's called a dividend aristocrat. It resides in the S&P 500, and it's not only paid, but has grown its dividend every year for at least 25 years. And I'm pretty sure it's a lot longer than that for T. Rowe Price. Okay. Again, I know nothing goes straight up, but you can almost get to the point where you can, if the dates weren't down here, you can almost pick what month we were in and what year. It's 2008. We remember. I hope everyone remembers what happened in 2008. 2018, both January and October of 2018, we had a severe drawdown in the market. A lot of people, it's like centuries ago, right? In this day and age, 2 years ago is forever ago. And then, of course, we had February of 2020. But other than that, we've got a good quality stock, pays a nice dividend, grows their dividend, has a good relative safety number, actually at 1.28. But again, our objective is that safe, steady dividend. I talked about building a portfolio earlier about growth stocks. So what we have here is the blue chip dividend payers. This is a little longer term. I begin a lot of my model portfolios just January. This one happens to be 2013. Why? Because it began as a 5-year portfolio 3 years ago. And I've continued to build and manage it over the years, and it's also part of our retirement coaching group. Okay. So when you have a portfolio focused on good quality dividend growth stocks, again, this was as of yesterday. This portfolio was up 133.6%. It began as a $100,000 portfolio. That is just capital appreciation. That does not include the dividends that were paid. Okay, that number. Okay, the portfolio manager doesn't know to automatically collect the dividends or uh, calculate the dividends. Just the capital appreciation has the portfolio up just under 17% annualized rate of return over the 8 years. That's pretty good, right? 16.9%. In fact, I think it's real good. What this doesn't show is the $35,000, and that's a lowball figure, of dividends that have been paid out for each and every trade done over those 8 years. Up to about a year and a half, almost 2 years ago, I was calculating out a spreadsheet to the penny of the dividends that we were entitled to for the life of the holding of the trade. And there's been a good amount of trades over 8 years. I mean, not that many, but over 8 years they build up. So I calculated every dividend payment, and I came to about 33,000 and change when I stopped. So this is a low ball figure. It's probably higher than that. Okay. And our goal, remember, wasn't even capital appreciation, but we're using well-known, good quality, mature, free cash flow stocks. That's the goal of a quality dividend payer. If you add that 35 grand, I think I'm doing the math right here, it brings me to 168% or $168,000 gain. Right? 33 and 35 is 68. My public school math serves me right. So yes, I'm rounding these figures a little bit here. But that would be the return when you add in the dividend payouts. So that means now we can calculate an annualized rate of return of over 21.25%. And I'll take it a step further. That doesn't even calculate the reinvestment of those dividends if that's what you chose to do. Okay, now you don't have to reinvest your dividends. It's just as fine to pull them out, pay some bills, go on a vacation, do whatever. But if you do leave them in your account, be sure to reinvest them because it would grow even more. So again, real quick, if I was looking to compare that again to the bellwether over those 8 years, it's 143% gain on the SPX, 18% annualized rate of return. So we still beat the S&P 500 with a very, very conservative investment plan collecting safe, steady income. All right. I've got two people typing in that there's no audio. Can everyone else type in and let me know whether you hear me or not? Can you guys hear me okay? If you can, just type in yes. John says yes, have audio. Yes, yes. Okay. Good. I'm sorry to interrupt with that, but a couple of folks had typed into the chat box that they had no audio. So there's a lot of reasons why that can happen. Usually it's on the other side, but Gary says, yeah, it's breaking up once in a while. I do see every now and then my screen flash a little bit, which is not a common occurrence, but maybe that's when it's breaking out. But we'll keep going. Ted says no problem since he mentioned it before. Okay, great. All right, let's keep moving. So that's the power of finding good quality, what I call blue chip dividend payers. I look at a longer term because that's the way you have to consider dividend payouts, right? I'm not going to build, a swing trading account of dividend portfolio, right? I always, half jokingly, admiringly call this, the most boring portfolio that I manage, and I say that in the most respectful, loving way. Okay, so this is a different objective, but it's another core strategy that you can apply to growing your net worth. Okay, let's take a look at the final. Whoops, I'm sorry, I skipped part two. I'm getting ahead of myself. Steady income. We're still on provide. Steady income flow from dividends and covered calls. I'm gonna ask real quick. Type in either yes or no. I want everyone to type in. Have you ever traded a covered call? Have you ever traded a covered call? Yes or no? Okay. Oh, they're coming in fast. No, no, yes, yes, no, yes, no, yes, no, no, no. Wow, pretty. It looks like a fairly even split between yes and no. Yeses are starting to take over. I feel like we're in Georgia doing a recount. Okay, I have to check these ballots. Um, okay, so a good mix. A lot of folks said yes, some said no. Okay, I just want to get a handle on this because I'm going to explain this as if you've never traded a covered call before. Okay, again, they are an integral part of growing your portfolio. So this is part two. Think of it this way. It's a way to, when you're providing income with covered calls, look at it as you are charging rent to the stocks that live in your portfolio. Right? That's a great way to start the introduction to that. There's a gentleman named Lee Lowell. He worked in the option pits. He wrote a book called Get Rich with Options, and he laid out in his chapter in this book on covered calls an explanation of what they are instead of getting all textbook. I just love this, so I highlighted it and I use it here. And he describes it this way. Yeah, what's a covered call? You have to understand there are other traders out there who will give you money today for the right to take your stock away from you if it reaches a much higher price. And somebody's going to pay you money to take your stock away at a higher price. It's a great way to pad your bank account. I still can't believe there are investors who aren't taking advantage of it. And frankly, neither can I. So I always thought really the most straightforward, logical explanation of what a covered call is. Here's the textbook definition. There are two types of covered calls. The first one is called a buy right, where you buy the stock and sell the covered call simultaneously, or write the contract. Selling and writing are synonymous here. Right? I buy the stock and I write or sell the call. So it's a simultaneous purchase of an underlying equity and the sale of a call of the same security. Remember, what is a call option? The owner, the buyer of a call option, pays money to buy that call. What he buys is the right to buy 100 shares of ABC stock at a certain price by a certain date. He's bullish. He hopes that the stock goes up. Okay. The seller of a call option gets paid, right? The buyer pays you money that goes into your account and is yours no matter what happens to the underlying stock. Okay. But you don't get paid for nothing. When you're the seller of an option, a call option, you take on obligations and you have to provide that stock if the buyer exercises his right to buy it. So if I sell a call option just in the open market, just what would be called a naked call, and I don't own the underlying stock, it's pretty risky. It's like shorting a stock. But what if the stock goes up and the buyer of the call option says, hey, I want to buy that stock at 50, it's trading at 80 now, and you sold me the right to take your stock. Well, I don't own the stock. I have to go out in the open market and pay 80 bucks or 90 bucks a share just to give it to you at 50. That's called a naked call. It's very dangerous. We don't do that. So the name covered call comes from the fact that we own the underlying stock. So we're covered. Stock goes up, you just take away our stock. Now, of course, you can also sell one option against every 100 shares of stock that you already own. Here's a quick picture of what I'm talking about. So don't worry about the dates or the prices of it's Dollar General it's the concept I want you to take away. So either you own or you go ahead and buy 100 shares of a stock, in this case Dollar General, and you pay $112 per share for that stock. Okay, I'm just setting up the scenario for us. I then sell a call option with a 115 strike. That would be called one strike out of the money. Strike is where you strike the deal. That's where the buyer has the right to take away your stock. Okay. They're paying me $2.65 or 265 bucks for one call option. They're giving that to me. It's mine. Okay. And they're doing that so that they can take my stock away at $115. So here's kind of a what if scenario for each occurrence. What could happen? If the stock goes down, the profits from the call that you sold help to minimize the losses on your stock. So what does that mean? Well, I bought the stock at 112 and someone paid me $2.65 per share. So when I say that the profits from the call minimize my losses, it means that I actually own Dollar General now at 109.35. Right? 112 minus 265 is 109.35, I think. Right? It lowers my cost basis. It gives me a cushion. Stock could actually go down $2.64 and I would actually make money. Now, if the stock goes below 109.35, losses will occur. But that's because I own a stock. It's not because of the option trade. Right? And we have pretty direct, significant management techniques to make sure that, we manage that risk. Now, the stock could go sideways. If it does, you make profits on the call you sold. You get to keep that money, right? And let's say the stock doesn't go above 115. Let's say it goes to 113 and a half. Well, I keep the stock and I can turn around and sell another call against it and generate more income and lower my cost basis even more. And then finally, if the stock goes up, you make what's called a max profit, right? Your profits are capped on a covered call. Some may look at that as a con or a disadvantage, right? But if the stock goes up above the strike price, you make your max profit. But you knew that going in, the most money you could make. You know that going into the trade where your capital, where your max gain is. So here's the result of this theoretical trade. At expiration, Dollar General closed at 119. Here's what would have happened to our position at expiration of the contract. I would have made $300 in capital appreciation. That's the difference between the strike price and where I bought the stock, $3, because they took it away at 115. And I get to keep the $2.65 or $265. So I made $565 in probably about a month, not even. That's how a covered call works. Here's a quick picture. Now, these are actual trades that we do in our retirement coaching group every Tuesday. If the market has got any signal to the upside, if there's a green light in the price column, primary trend's up, of course, if confirmed call is up and the market's moving in the upside, because it is a bullish trade, we perform a covered call used to generate income. So I'm going to click through these fairly quickly. Keep in mind, again, these are real trades started back in June of 2019. Started in June of 2019. We bought 300 shares of AMD and simultaneously sold 3 calls. A month later, we closed that trade for a profit of $603. Okay. That's a 6.81% return on investment in just 31 days. Okay. That's a great trade. Think of it this way. My objective is to generate income. What if you had a stock that paid you a monthly dividend of 6.8%? Not an annual dividend, a monthly dividend of 5% or 4%. Okay, think of it that way. So I'll scroll through these. We continued on in our Tuesday sessions using our process to find stocks, because we had other stocks as well. I'm just showing you AMD because it was one of the great performers. 7.4% in 28 days. Buying the stock, selling a covered call. We did it again. Our process had us in some other good stocks during this uptrend, but we got back in November. This one was 28 days. We got 4% return. A couple of more there were in December. This was just 10 days, 5% in 10 days. And then I kept the slide in. The slide was created. We had just opened one. This was in February. This was before the pandemic hit. The sell-off came. We had opened one, and I wrote on the slide, I said, I'm not sure where it's going to go. But at that point, we were up $375 already. Well, I came back and edited the slide because on February 18th, we closed that AMD position for a profit of $538. Okay, so that's just a way of going through that. And before we're done here today, before I sign off, I'll show you a spreadsheet of the years of the year long, all the trades we've done this year. We've got, uh, I'll call it 79.8 winning percent trades, winning trades, and we're up just over 20% in the portfolio. So I'll show those right before we're done. It's a great way to generate income. Very easy to do, very easy process. Which leads me finally to capital preservation. Okay, again, in my opinion, the most important part of what I've been talking about here. The great hedge fund manager Ray Dalio, I paraphrase a little bit his quote, and he said, "You cannot make money in the market without taking some risk." Okay, how much risk you want to take depends on you. We're talking about safety and reducing risk. But he said, you can't make money in the market without taking risk. And he said, and you certainly cannot keep your money without being defensive. Right? And it's one of the really good ways that I've heard of getting across the point I'm trying to make. Right? This is all great. But if you don't know when to strategically defend your portfolio and defend capital appreciation and income, it's all in vain. So let's talk about protective puts, right? And we'll talk about the strategic times that you need to apply the insurance policies, really what it all comes down to. I'll review the quote by Mr. Twain. Don't just sit there and worry. Be proactive. Do something, anything about what's worrying you. Okay? Why do we do that? Because it's up to you. It's incumbent upon you to protect your assets. Okay? Our goal is to reduce risk. And so this was the other option trade I was talking about. We buy put options to protect individual stock positions, or you can do it to protect your entire portfolio. There's also a trade called a collar trade that combines the covered call and the put option. It's a great defensive measure. I'm not going to go too far into that one, but I am going to talk about simply buying a put option to protect, protect an individual position, and I'll show you how you can do it on your overall portfolio. It's all about an insurance policy. Most likely, you have home insurance. You have car insurance, you have life insurance, you have health insurance. Heck, my wife and I, we have insurance on our two dogs. We have pet insurance, for crying out loud. Right? We insure everything. It's no different. Right? You have an asset, you insure it. Same thing with an individual stock or your overall portfolio. You want to be able to insure that asset. If it's damaged, your insurance policy will help to pay for it. Here's a case study I want to walk through to illustrate what I'm talking about. I'm going to use Texas Instruments. Again, don't worry about the time frame. It's just the illustration. It's a good illustration. That's why I continue to use this one. It doesn't matter the time or the stock, quite frankly. But a good quality stock, back then, a high RS stock that was purchased on 11/24. Why? Because it was part of a search that showed us good quality stocks on a confirmed up call. Right? Could have been this confirmed up you bought it at, maybe way back here. Either way, you made a great trade because the stock continued to rise. Right? Followed a process, stock went up. That's wonderful. So let's say we bought it just under $100, right around $100 on this date. Stock goes up. The scenario says that in January, from November to January, we have a gain of 20%, roughly $2,000. Bought it at 100, it's trading at 120, give or take a few pennies. Again, because we did it right. We followed the process. Because we do our due diligence on every stock we own, we know that 1 week out from this move and where the stock is trading, we know that there's an earnings announcement due. Right? So it's time to act. It's time to be proactive. Because you get worried when earnings come out. So I'm going to be proactive, like Mark Twain tells me to be. Here's the mindset I need you to have. Yes, we bought the stock at $100. That's my cost basis. I'm up to 120. In my mind, I know I don't own the stock at 100. I own it at 120. Right? That's where it is. That's my money. It's my stock. It's my job to make sure I don't give that money back. Now, listen, there's some volatility, things we don't. You give a little bit back, but that's not what I'm talking about. Protecting from major drawdowns here, giving back my profit. Right? If you do nothing leading into an earnings announcement and that stock gaps down, I'm going to be blunt, right? Because you're here and you understand now there's something you could have done, right? It's going to be your fault. It's going to be your fault, not Kramer's fault, not the government's fault, not a politician's fault. It's going to be because you were not proactive. So here's the scenario. 1 week prior to earnings, you want to protect your gains. What could you do? Well, you can buy an insurance policy or what's called a put option. Quick definition of a put option. If I buy a put option, it gives me the right to sell 100 shares of TXN, in this case at $120 by the expiration date. Right? It's an insurance policy. It means I can go to bed the night before earnings and not care what happens to Texas Instruments. I don't care. I don't have to worry about it. It's the only way I know of that you can go to bed the day before an earnings report and not care what those earnings are. Here's why. What happened was Texas Instruments a week later announced earnings. I don't know if the earnings were poor or guidance or something there dropped the stock. The value of our put option went from $423 to $1,128 on that very day. What happens with a put option, I buy the right to sell the stock at 120. When the value of my underlying asset falls, or to keep it in insurance terms, when it's damaged, the value of my put option rises. Okay. This insurance policy covered my damaged asset. Had you not bought insurance, your $2,000 unrealized gain is cut in half. And again, to me, it's unacceptable when you know there's something you can do without giving up half of the earnings that you've gained. Right? Because you bought insurance, what happened? Well, we made $700 on the insurance policy or the put option, the protected put. $1,700 now is what our position is worth. So we mitigated our loss at that point down to $300 on the overall position. Okay, that may not sound like much on 100 shares of TXN over one time, but if you own 10, 12, 15 stocks, and you are able to mitigate and understand how to protect your portfolio, that's going to make a big difference over time. Right? You lose time, use of money. I'll talk about when the overall portfolio in a minute, right? There's no need to give back that money. Right? So you drastically mitigate your losses. And then the great thing is it gives you the choice. Do I want to continue to hold the stock or is it time to sell it? So I'm not going to ask you to type it in. I know the answer. Would you rather have insurance or protection on your asset, or would you rather not? I think I know. Well, I guess with the sound problems, I need to make sure you can still hear me. So, someone type in yes, just so I know. Protection, safety, insurance. Okay, there we go. It takes a minute for him to come through. All right, great. Yes, of course, we'd rather have protection. All right, wonderful. Let me quickly just talk about how to do the same idea, same concept. Buy a put option, but this time I'm going to talk about doing it on the overall market as a way to protect your portfolio. If the VectorVest program signals a downtrending market, as it did in February of this year, you better heed that advice and be proactive. Here's why. I created this slide doing a presentation before the February sell-off this year. I was doing it for a whole different presentation. And I was starting from my webcast and talking to people. I was starting to feel as that at this point, everyone thought the market was just going to go straight up and never go down again. It was starting to irritate me a little. So I was creating this presentation to say, listen, don't tell me about this wonderful move in the market. And this was still just 2019, when a year earlier, that point, it was only a year. Don't talk to me about this without remembering this. This was October to December, a 20% sell-off in the S&P 500 90 days. A lot of people forget what happened then. Christmas Eve was the bottom, and it took off like a bird. We know that. But the problem is, it took you a year before that rally started. Now, it did cross above, but it pulled back. It took a year just to get your money back. Just to get, if you've done nothing. Just held stocks right through it. You'd sat there and would have, the time use of your money would have been wasted for a year. Then the market took off, and that's wonderful, but you would have been prepared for that as well. So I'm going to zoom in a little bit on this February, right? And then I'm going to click one more time and zoom in even more. This date is February 24th of this year. We have a market timing signal called the DEW. It went to a down situation on the 24th. Okay. What do? Well, you listen to Mark Twain and you become defensive. The headlines were starting to come out. The market sold off on that day. Buy a put, SPY, that's the ETF that tracks the S&P 500. Buy a put option on the overall market as an insurance policy. 4 days later, we got the confirmed down call. That's our last line in the sand for a downtrending market. If you ignored this one, again, that's incumbent. It's your, I don't want to be too blunt, but it's your fault if you did nothing. So what could we do? Well, we could buy a put option on the SPY. Here's what it would look like. First with the DEW. And I'll walk through this fairly quickly because it's just like Texas Instruments. I buy the insurance policy on the SPY on that date. Now, this is a theoretical trade. The other trades I actually place. This one is theoretical. You could have bought one SPY, and I'm going to use just one contract. You could have bought more if you want to. One SPY, April expiration, 322 strike price. I buy that put option. That's where the SPY was trading on that day. So I'm buying an at-the-money put. It's going to cost me $9.75 or $975 for one contract, which when you're talking about your overall portfolio, buying 2 or 3 or 4 contracts is not that much money. Okay, it's the cost of doing business. Well, as we know, the market crashed. That put, just a couple of weeks later, is trading at $71 per share. That's a $6,000 profit on the put option. Now, before you type anything in about, well, how'd you know when to get out? I didn't. I'm just showing you the potential. Had I gotten out anywhere in this range, I still would have captured a good portion of this profit. Right? I have a damaged asset. My portfolio was damaged. My insurance policy helped cover it. Okay, to the penny, I can't tell you. Now, I could tell you that the entry point is pretty clear. That I could tell you. Whether it was the 24th or the 28th, same thing. But now what happens? That now the SPY is trading down at 296. Now I'm going to pay $14 per share. But just a few weeks later, that 296 puts now trading at $67 per share. So you only get $5,300. Now again, I'm not saying that's the day you would have sold it, but anywhere in this range, that SPY, remember these are big, these are $20 increments on this log here. Right? S&P 500 went down a lot. Even if you sold it somewhere in here and profited, you would have mitigated your losses tremendously. So when we look at equity curves in our portfolio and we see days like October of 18 and like February, we are able to mitigate these losses by being proactively defensive. Right? I don't have to sit through this and need it to go all the way back up here to break even. There's no reason to do that. Elaine is a customer of ours, a subscriber and a student, and you know it always means a lot when I get to read something like this. He wrote a letter to us, said, Jim, because of your teaching, I hedged my portfolio January of 2018. Again, for those who don't remember, it was short term, but it was a very dramatic sell-off in the market. And we talked about it in our one of our courses or our coaching group. I'm not sure which. And this is what he did. $835 netted him $23,000. Okay. Actually made money. And this is why, because the The S&P went from 285, traded as low as 255. This was trading almost, well, even higher than 285, 290, 295. It's a huge move. Because we strategically defended our portfolio, he was able to save his portfolio. You can't keep your money if you don't know how to be defensive in the markets, as Mr. Dalio said. So, gone through the three core strategies. We talked about a growth portfolio. I showed you buying good quality high RS stocks, how you can grow your portfolio uh, by capital appreciation. I talked about the dividend portfolio. This is the same slide from before. That's why I'm clicking quickly here. Okay, we outdid the S&P 500 with the most boring, the easiest portfolio to manage in the world over the longer term. I showed you the power of covered calls when done right using a process. It's a great way to pad your bank account, as Mr. Lee Lowell said. We talked about being proactive on individual stocks and the overall market. Okay, again, this was the same slide. I'm just clicking through that. So those are the three core strategies that every retiree we believe must know to protect and grow their retirement nest egg. The question you may ask yourself, how can I implement the three core strategies right now so that I'm prepared for the next drawdown or prepared for the next upturn in the market? How can I build my portfolio and protect it? Okay, well, it's time to make a choice. Right? You can do it alone, but that might take a while. Plus, if you keep doing what you're doing and you're not having the success you want, of course, you'll still continue to make the same mistakes. Trial and error are just, as this wannabe carpenter found out, right? You can use trial and error, but you run out of fingers at some point. Keep making those same mistakes. Get out of the maze. Right? You can do it fast. Use a system that's been proven to work so that you can bypass the years of trial and error that a lot of us go through. Okay? And that's why we put together a course called the Ultimate Retirement Solution online course. Okay? Protect and grow your retirement nest egg, your net worth. And so if it's okay, I want to just take about 3 minutes here. If you stay with me, I want to tell you all about the Ultimate Retirement Solution course. It's designed to take you by the hand and guide you through the method you need to grow and protect your retirement account so that you can retire with peace of mind. Okay. First, I'm going to give you the modules. These are the lessons that we teach. There's a lot more that goes into it than just this. So stay with me just for about 5 more minutes. We start with Module 1. I believe that you cannot succeed unless you take the time to define your objectives, write out your own vision statement, understand your portfolio allocation, and set clear goals. Okay, that's Module 1. It'll lay that foundation for us. Module 2 allows us to go in, and actually that same portfolio I showed you comes from building the portfolio by buying the right stocks, right? Putting that team on the field. But then we'll talk about setting up the plan, the risk management plan behind it, right? What kind of exit strategies, what kind of strategic defense are we going to use in that portfolio? So by the end of that module, you'll have the ability to build a nice growth portfolio. We'll shift gears and talk about building your dividend growth portfolio, the important characteristics of a quality dividend stock. We'll show you how to find those. I'll talk about blue chip dividend payers and some other great strategies that you can use. It's very important, again, to be able to generate that income. Modules 4 and 5 are going to discuss, again, those two very basic, very commonly used option trades. The first in Module 4 is the income stream that you can generate from understanding the covered calls, the type of stocks, when to buy them, how to set them up, what strike price do I use, what expiration date do I use, and every bit as important, how do I manage that position once I've placed it? Go all through that in Module 4. You guys, many of you, I think, probably remember the Strategic Defense Initiatives back in the early 80s, Strategic Defense System. Okay, we want to talk about being prepared, knowing what to do, how to ensure your portfolio, how to know how to identify those defensive signals in the market. Confirm down, DEW down, there's a lot of different reasons. Usually earnings and DEWs and other headlines that may compel you to want to protect your portfolio. We'll show you how to do it. And then finally, in Module 6, we'll talk about, again, allocating funds, portfolio automation, and then we'll take Module 4 here and we'll walk through a very specific system of selling covered calls to generate a safe, steady income. So what we learn here will actually break down a step-by-step trading system to be able to do that. Okay, these are the lessons. These are recorded and archived in the VectorVest University page that I'll show you in a moment. Okay, but the course comes with so much more. By the way, at the end of the course, you have access to all of the information I'm going to share with you right now for 1 full year. So it's not like you finish the course, it's over, and you're out on your own. What else do we get? Well, not only do you get those 6 modules to watch and learn from, but we're also going to have 6 live mastery support sessions every Monday starting, I believe, whatever the 20th, I believe it's the 20th. I have the dates on a slide here in a second. I'll show you. Starting on the 23rd of November, for each module, we will have an hour-long live mastery support session to walk through what we learned. I won't reteach the module. I take a slide or two from each key principle and we'll review it, and then I'll answer any and all questions about what you're doing in preparing and building your portfolio. If you can't make it, we have a dedicated email bin to submit questions, and later on each Monday we will have the recording archived in the site that I'm going to show you in a minute in the VectorVest University. Okay. The next bonus to taking the course is my favorite part of what I do here at VectorVest. 6 weeks to access the retirement coaching group. I mentioned it earlier. It's a separate entity, but by taking the course, I'll actually walk you through some of the things that we do in the course. Okay, some of the things that we actually do in the course, and I'm going to give you 1 or 2 quick examples here. If I can bring up a spreadsheet here, I just want to show you what we do. Here's an example. This is our year's trade for our covered call trades. Okay, it's on a spreadsheet. I won't go delve too deep into what we do here, but it's all automated. When I enter in a trade, it's going to give me my max profit, profit targets, and the like. These are the current trades we have open right now. Okay, and here are our results. We've got I think 28 trades, 25 profitable trades. And if I hit the button up there, we're up over 10 grand, and we've never used more than $50,000 in this portfolio. We do 1 trade a week, so we're never fully invested. We don't have to worry about getting overwhelmed by 1 or 2 bad headline days. And so, doing 1 trade a week on good, and you'll see here, I was talking about AMD earlier, right? Here's the positions, right? AMD earlier this year. We used AMD again using the process, another profitable trade. These aren't the ones I showed on the slide. These are this year. Those were last year's. AMD here, 616, another 1100, another AMD, another 1170, and we currently have an AMD that's profitable and open right now. Now, do we have a couple of losing trades? Of course we do. And I still lose sleep over this trade. I allowed it to get out of hand a little bit. That was my fault. But 80% winning trades. So it's a great way. 1 trade, pay for the whole course. Now, we invite you to access the coaching group. Now, we do that trade, but we also look at portfolios. We'll show you how in just a few minutes a day you go through, make sure we do our due diligence, make sure earnings aren't coming up in any stocks. How is it working with our where our stop criteria is, or our risk management techniques. I can even show you the account that we use. Here is our buy rights are on this page. If I go here, you'll see AMD. We currently have an open trade. I have my orders in to close the trade already. I have a Lenore. It's a housing builder. We just put this trade on a couple of days ago. Took a little hit today, but we're still up overall. Okay. And then we have a NetEase trade that didn't make it into there, but we're up 57 there as well. So that's what we do. We also have what's called a a master portfolio where we're able to uh, illustrate collar trades, covered call trades, right? Where we actually go out and place them to show you how to protect your portfolio. So that's what goes into the 6 weeks retirement coaching group. You're invited to that for free for 6 weeks. Not only that, but if you want to, if for those who maybe do trade options here, we have a bonus module by my friend and colleague, Mr. Ron Wheeler. He focuses more on spread trading, credit spreads, using options to generate a monthly income. You get a great hour-long bonus module along with that, and Ron does that live. High probability of trades opens up another income stream for you. Okay, that's a great bonus. If you're in the room and you're new to VectorVest, you don't have a an account with us, we'll give you a 60-day trial period. So basically, that's the life of the course. You'll have access. It's the best tool to determine market direction and to be able to find the right stocks at the right time. What's the value of that? If I scroll through all of those things I just talked about, it comes to about $2,500. Now, if you order before, well, it says before the end of the webinar, but you've got a little time after the webinar ends. Okay, what we call the early bird price. The regular price of the course is $9.95. We have an early bird special that lasts for the next week or so. But because you were kind enough to take the time to be here, we're going to knock another $100 off the price and give all of those resources to you for just $495 that you have access to for a full year. I'm going to show you how to get in there in a minute. Okay, where you go to type in is www.vectorvest.com, and I'm going to type that link right into the chat box so that you can go ahead and click on it and see where the page is to sign up if you're interested in signing up for the course. www.vectorvest.com/URS, $495. And here's the thing, they say in the markets there is no such thing as a risk-free trade. Well, after this course is over, if you show that you've showed up, have done the work, and you're not satisfied, we will gladly give you a 100% refund on your money. So it is a risk-free trade. Okay, take the course. You don't like it, we'll give you your money back. That's how confident we are you will enjoy the course and you will learn from it. How much is it costing you not to do this? That's a question you need to ask yourself. How much money will you lose? How much potential profit might you leave on the table? How much time and energy will you spend trying to do this on your own? And then ask yourself how your life may be a little bit different if you do this and it actually works. And it's never too late. They say the best time to plant an oak tree is 20 years ago, so you can sit under the shade today. You know when the second best time is, of course, and that is today. So it's never too late or too early to begin to plan for the long term. So you have a little time. I'm going to stay on here and answer any and all questions for the folks remaining in the room. So if you have questions, I'm going to stay here as long as you guys want me to. $495, vectorvest.com/URS. Here are the live mastery sessions at noon Eastern Time for these 6 Mondays in a row. They're all recorded, they're all archived. And then on Monday, you can start the new year off with a great bonus session that Ron will present for you. And you can do all that by going to vectorvest.com. $495. It's one AMD covered call. That's all it is. That's all it is. So if I click on that link that I typed into the chat box, www.vectorvest.com/URS, this is where it will bring you to a page where if you read through it, describes the course. It has all of the information that I just kind of ran over pretty quickly. And look, somebody live will even come in to help you with any questions that you have. We'll go ahead and close down Q for now. $495, that price will be up there for a little while longer. If you click purchase course now, what will happen is you will come to this page. $495 buy now bonus is currently posted. Click proceed to checkout. If you are going to sign up and you're new to VectorVest, you don't have an account with us, simply put in your information here, your basic information, and then hit submit. And it will walk you through two or a couple of basic steps after that to get you signed in and ready to go. That's if you're new to VectorVest. If you're a current subscriber and you want to sign up, simply click sign in here. Just click sign in there, and it will take you right in to your VectorVest account. Well, not into your account, but it'll bring you to this order form, and it will follow through, and you can just walk through that. Okay, so that's all we need to do. Okay, I want to take a second and show you. No, that's not what I wanted. Let's go here and a new window. There we go. Here's what the actual course looks like. I want to show you the resources that are involved. So if you go to the site university.vectorvest.com, there's no www in front of it. Right? University.vectorvest.com. As a subscriber, you'll come here, you'll sign in to the university, which I'm already signed into, and I'll click my dashboard. Now, and again, Koo will come in and ask me if I need help. Now in here, that's live, by the way. It's a live chat. He's out on the support floor. I scroll down. Now, I have access, of course, to all of our courses. Don't get confused by all this. But when I come down to the Ultimate Retirement Solution course and I click Continue, okay, here's what it's going to look like. You're going to have a welcome video, then Module 1, Module 2, right? So you'll click in Module 2, let's say, I click on the presentation. This is the recording, right? It's about... it's over an hour long, and it's going to walk through all of the information that we use in the module. Okay, let me pause that. We have homework assignments, and then we actually have, as a resource, a video to walk you through that homework assignment. That mastery session I talked about, this would be an old mastery session right now from the last launch of the course. On Monday, the 23rd, a couple hours, however long it takes, a couple hours, we will post the live mastery session. Then that goes through all of the modules, goes to the bonus modules, and then here, retirement coaching, click that arrow, and that's where you get your 6 coaching groups, right, that you're going to be invited to. If you can't make it, it'll be archived here and you'll be able to see it. Our resource tab also has, for each module, if there happens to be, a checklist. Okay, module 6, I believe, has some or 5 maybe. We have checklists. We have all kinds of things, but they're available to you. Here's where you have access for 1 full year to all of the videos, all of this masteries, and all of the other things that are here. Okay, so it's not just the 6 modules. There's a lot that goes into it. Okay. So with that, again, I'm happy to answer any questions that you might have about anything we talked about the Ultimate Retirement Solution course, the money back guarantee that goes with it. If any of you have gone to that link and signed in, go ahead and click I'm in the chat box, or I've signed up, so I can tell you what to expect once you are signed in. What will happen is you'll get an email with all of the instructions you need to get access to it. You should have access to it by either later tonight or tomorrow to that site that I just showed you in the university. Okay. So I'll stick around for a few minutes. Any questions at all? Go ahead and type them in for me about what we talked about or about the course, either one. Okay. Sometimes it takes a minute to come in. Anybody try to get to that page? Anybody having issues with that page? Is there anyone who can still hear me? Okay. All right, I'll give it another 30 seconds. Make sure there's no questions, comments. Well, I'd just like to thank you all for those who are here to please stay safe, stay healthy. Thank you for taking the time to join me here today. If you have any questions, give our product support floor a call. And we look forward to seeing you either at the course or we'll see you at our next event. Thanks, everyone. Stay safe and have a great evening.